What strategies can we use to reduce tax this financial year in order to limit the leakage caused by tax on your overall financial situation as we deal with this difficult COVID-19 period, just as we did during the aftermath of the global financial crisis in 2008-2009. Concessional or pre-tax super contributions are a great way in which to reduce tax. Now, concessional contributions are pre-tax contributions and include the 9.5% super guarantee contribution that's made from your employer. These contributions are tax deductible, and we have a limit of up to $25,000 that we can contribute pre-tax into super each year. We can now contribute any personal cash we have accumulated into super to make up the gap between what our employer puts in and this $25,000 limit, and thereby claim an extra tax deduction. In the past, we've not been able to use up any of the unused concessional contributions in previous years. However, from this financial year, we can use up last year's financial year limit, plus make the contribution this year and claim a larger tax deduction, as long as we have less than $500,000 in superannuation and we're able to contribute to super. As I've mentioned in previous videos, protecting your most important asset, that is, your ability to earn income, is critical to ensuring that your financial situation is secure and that you've got a safety net that will protect you during any unforeseen disability or illnesses that may strike. Not only do these policies act as a safety net, but premiums can also be tax deductible to the individual. And a great tax planning strategy is to prepay income protection premiums prior to the 30th of June in order to deduct the entire premium for your income protection in the current financial year. We've all experienced the market volatility that's been ever present due to this COVID-19 pandemic, and we've all got some assets that we've lost money on since we've purchased them. Similarly, you may have assets that you've purchased and made profit on over the first 6 months of this year that you may have sold before this market correction took place, and you've got to pay tax on the capital gains that you've generated on these good performing assets. So strategically, if we have some assets such as stocks that are in our portfolio that we've lost money on, we'll be able to sell them and use those losses to offset any previous gains from the same financial year. Now, the last strategy involves superannuation again. Now, superannuation is a really good vehicle as it allows you to save for your retirement over the long term. And to reward you for locking away your money for a long period of time, the super system gives you really good tax rates on both capital gains and investment income within the superannuation system. For instance, investment income or interest generated in super is only taxed at 15%, and in pension phase, when we do retire, it's even better at 0%, whereas outside of super, that income is taxed at our marginal tax rate. This does sound too good to be true, as it is a great tax benefit, and to limit the amount that it costs the government, there are annual limits as to how much we can put into super from personally held assets. So there you go. There's 4 simple strategies amongst several that you can look at in order to reduce tax this financial year and reduce the leakage of tax from your cash flow during this difficult COVID-19 period, just as we looked at doing at the aftermath of the global financial crisis in 2008-2009. Please note, this is not advice, and you really do need to sit down with a qualified financial planner in order to discuss these strategies, your goals and your objectives, in order to formulate a plan in order to reduce tax this financial year. If you found this video informative, please give us a thumbs up and subscribe to our channel to be kept up to date with any future videos that we present.